Well, good morning, and can I welcome everyone to this, the 17th meeting of the Public Audit Committee in 2025. The first item on our agenda is for the committee to consider whether or not to take agenda items 3 and 4 this morning in private. Are we all agreed? We are agreed. Thank you very much. And agenda item 2 is consideration of the Auditor General for Scotland's performance audit into the Scottish National Investment Bank. So I'm very pleased to welcome our witnesses to the committee this morning. We're joined by the Auditor General, Stephen Boyle. Good morning. And alongside the Auditor General this morning is Cornelius Chikwama, who is Audit Director at Audit Scotland. And we're also joined by Catherine Young, who is a Senior Manager, and Kirsty Ridd, who is an Audit Manager at Audit Scotland. We've got some questions to put to you, Auditor General, but before we get to the questions, I would like to invite you to make an opening statement.
Many thanks, Convener. Good morning to the committee. I'm pleased to bring to the committee my report on the Scottish National Investment Bank, which we published earlier this month. Convener, the bank was launched by the Scottish Government in November 2020. It provides long-term investment finance to businesses and projects with the aim of supporting sustained economic, social and environmental improvements across Scotland. The Scottish Government is the sole shareholder of the bank, and the bank's missions are to address climate change, transform communities and scaling up innovation and technology. In our view, the bank has worked hard to establish its position in the Scottish investment finance landscape and has a clear understanding of its purpose. It has made good progress with its operational, governance and reporting arrangements. And this includes establishing robust risk management arrangements to mitigate what are the inherent risks of investment financing. The governance arrangements put in place by the Scottish Government effectively balance oversight with maintaining the operational independence of the bank. The Scottish Government's ambition is for the bank to become what's known as a perpetual investment fund that is not therefore dependent on ongoing public funding for its capital investment requirements. But current HM Treasury financial management rules present barriers to achieving this, and action will be needed to set the way forward. The bank has currently delivered against its objective to self-fund its operating costs by 2024-25 and therefore helping to reduce its dependency on the Scottish budget. But single-year capital allocations from the Scottish Government can be difficult to align with the bank's long-term investment activity and make maintaining this position a challenge. Convener, lastly from us, it's perhaps too early to make a full judgment of the impact of the bank's long-term investments. But what we've seen from our audit is that it's established good monitoring arrangements and reports that it is on track against its 2030 impact ambitions. As ever, Convener, between the four of us, we look forward to answering the committee's questions. Thank you. Thank
you very much indeed for that opening. I'm going to go straight away to some questions from the Deputy Convener, and rather than asking questions at the end this morning, Jamie Green's asking them at the beginning. So, Jamie, over to you.
Thank you. I'm very grateful, Convener. Auditor General, thank you for your opening statement. It's probably the first time since I've joined this committee that you've given an open statement that didn't criticise the organisation in any way, shape or form that you're here to speak about. And I know you always do that respectfully and with an intensely academic view of the world. But is there any particular reason why the report didn't pick up any governance or performance or operational issues at all?
So I think, as with all our reports, Deputy Convener, we're evidence-led. So based on the scope of our work and then the consideration of the evidence that we encountered over the many months that we undertook our audit, where we looked at the operational arrangements for the bank, how it was managing. I think we talked about some of the inherent risk that comes with investing, and it's in the bank's position of adopting a place where it's having to engage in some higher risk investment activity, and how it had structured itself to manage some of those risks. Together we're looking forward to what it wants to achieve, how is it performing against its impact ambitions, have led us to the conclusions that you see in today's report. I think perhaps not to disagree with you, Deputy Convener, but I think what we are pointing out is that there are still challenges to overcome if the bank is to be successful in delivering the ambitions that it has for itself and those that are in its sole shareholder, the Scottish Government, and then particularly looking at how it will manage the finances of its funding. It hasn't yet reached a position where it's had to exit from some of the investments, but how it will manage what happens to that flow of funding, because it can't at the moment retain that money when it comes back. And then perhaps, of other factors that we pointed out in today's report, the bank needs to perhaps make more progress on its impact reporting. We've seen a recent impact report from the bank, but perhaps to more clearly explain some of its investments. And then building on some of the feedback that the bank received from its shareholders, that whilst it's made more progress, there is significantly improved awareness of the bank and its responsibilities. Given some of the nature of the stakeholders that it deals with, there's an appetite for perhaps more pace from the bank too, that it can take decisions more quickly. But I think it's a fair assessment that you make. This is perhaps one of the more positive reports that we've made, but absolutely we're evidence-led in the judgments that we make.
Thank you for that explanation. And yeah, it's refreshing. It's nice to see a positive report that identifies good governance and operational practice. But I'm sure some of those areas that you did raise, other members of the committee are going to cover, particularly around the two areas of potential improvement around impact reporting and awareness of the activities of the bank. But it is interesting in both your last answer and your opening statement, the areas of, I guess, risk to the long-term success of the investment bank are actually external factors. So the first being, of course, its mission to be a perpetual investment fund. And you mentioned that the barriers to that are Treasury-led rules as opposed to the bank's own operations. And the other, of course, being the annual capital allocation of funds from the Scottish Government. Again, that's something outside of its control, albeit it's owned by the Scottish Government. So how do you think it will be able to address those external factors?
I think it's as much a question for the Scottish Government as it is for the bank. In terms of the annual funding arrangements, it is linked to the other point, but I think that this was identified really going back to the implementation plan that was coming on 10 years or so now when the project was first mooted, and then the arrangements that were undertaken to explore the possibility of a Scottish National Investment Bank, what its responsibilities might be, and then that perpetual investment fund requirements. As you know, Deputy Convener, the Scottish budget is set on an annual basis. So public bodies receive resource and capital funding following the Scottish Parliament's consideration and scrutiny of the budget. Unlike in other parts of the public sector, particularly local government, is that the central government bodies don't have ability to hold reserves or typically carry funding over from one year to the next. As we mentioned in the report, and I think has been covered elsewhere, the Scottish Government has said that it is exploring with the bank the ability to deploy end-year flexibility that might address that first point. But I think, like others, we await detail as to what that actually means in practice. And then linked to your other question about the perpetual investment fund scenario, it is HM Treasury rules that will have to be addressed, or I think it's a dispensation, is some of the language that's used, that would be required to allow for resources when an investment comes to end to be channelled back to the Scottish National Bank and then be redeployed. The milestone that's maybe worth looking out for is that UK Government HM Treasury are currently reviewing the application of financial transactions. The financial transactions have been the primary source of funding for the Scottish National Investment Bank, but as I know the committee is familiar with, that their presence has been significantly reduced in recent years. And that will pose important questions for the Scottish Government, depending on the outcome of UK Government's review, which I think has been signalled to be really soon, so potentially as soon as next month when they settle that, aligned with the UK spending review. And then, of course, we know that the Scottish Government itself is planning for its own medium-term financial strategy, delayed from this month into next month. So these are the important factors I think we've identified in today's reports, that these two elements have to be addressed if the bank is to deliver upon its overriding ambition to be able to invest in a planned way consistent with what the market expects, and then what then happens when investments come to an end.
Can we look at some of those numbers in your report? We had a discussion before the meeting started just to get our heads around them, and maybe you can help clarify your understanding of some of the top-level numbers involved. Page 3 is the key facts page, and it states that £785 million of capital has been committed for investment by the bank since its launch, but Exhibit 1 refers to the Scottish Government capital allocation over the course of the bank's existence, and that's £1.1 billion, as you say, of which much of which is made up of financial transactions, and a smaller amount of resource allocation, of which there's actually zero in this year's budget. Can you just talk me through how those two numbers correlate? So, in my reading of that is that the Scottish Government has allocated over £1 billion to the bank, but it's in total invested around £750 million. Does that mean there's money sitting in a pot somewhere waiting to be invested? Just so we understand the numbers.
Yeah, I'll bring colleagues in. Actually, might want to say a wee bit more. I'll come to Cornelius in a second. But effectively, you're right. That is the rationale for why there is a difference. So Exhibit 1 on page 16 sets out the total allocations. But I think probably goes back to the discussion I think we've just had in some respects, because the bank can't carry forward funding from one year to the next. And as we heard very clearly from them during the course of our audit that they'll be led by both their missions, but their risk management, their investment risk management arrangements. So they're not rushing to spend an allocation. And if that means that they'll underspend, then it's, to some respects, so be it. The investment has to be right rather than it has to be to deliver the allocated budget. But that really, I think, explains, and Cornelius can say a little bit more about the difference between those two numbers. But perhaps maybe a fairer comparison would be, because what we've done in Exhibit 1 is we've also included the 25-26 capital allocation, but we don't know what's actually been spent for that year. So maybe looking up to the 785 relative versus to 998. So we strip out the funding that's been allocated for 25-26. But I'll bring Cornelius in if there's anything he wants to add to that.
Last year, for example, which is a year ended already, there was £174 million allocated. Presumably that's made available as opposed to physically moved into the bank's coffers. Trying to get your head around whether that money has been allocated to investments, because if they cannot, if you like, underspend or roll over cash, then presumably it's just either not drawn down at all, or it gets sent back to the government. So actually, of that 174, there could have been a percentage of it which wasn't actually invested. So allocating money is a sort of made-up number. You could say you could allocate it £1 billion, but if they can't spend it in that financial year, you're not actually allocating them that amount of money. That's the sort of transaction I'm trying to get my head around.
Yeah, I think you're right. Actually, sorry, I think you're right. It's that there will be I think there always will be a difference between what's spent and what is allocated until there is resolution of these points about year-end flexibility, because of the nature that investment opportunities they won't fit neatly into a financial year end or budget allocation process. But I'll bring to Catherine in first of all.
Thanks, Auditor General. I think in paragraph 46, I think we say each year to date the bank hasn't fully invested its full capital allocation. I don't have the figures to hand for each particular year, but yeah, I think the challenge there is, and particularly when bringing in private investors, it doesn't always work alongside that annual budget timeline. So there will, of course, be cases, and the bank has been very clear it will not just invest to spend that money in that particular year. It's strict investment criteria. It would pause at that point to allow it to obviously make all of those correct decisions around investing. But yes, there will be a degree, as you say, or percentage of capital returned or not drawn down across those years.
Okay. That's very helpful. The other big, I guess, selling point of the bank is this so-called ability to unlock private investment. Now, my understanding is that the bank does not or would not regularly invest at the start-up stage of a business, but rather at the so-called growth stage, which I guess there's some ambiguity as to what that actually means. But is there any sense of feeling, I think the number that you used, again, going back to your own report, is £1.4 billion of funding attracted from other investors as a result of investment. I mean, that's quite a bold statement to make. So, this idea of it's unlocking private capital, how do you quantify that? I mean, it's a bit like saying you switch a light bulb on and mosquitoes will come to it. So did you instigate that by switching the light on? It's easy to put this down as a metric of success because it's such a big number. But it must be very hard to actually pin down in real terms.
Yeah, I'll bring colleagues in actually just say a little bit more about. I'll come to Cornelius in a moment to say about the methodology with which the bank uses to arrive at that assessment. But I think the principle which they are citing is they say for their investment of circa £800 million, or perhaps slightly less than that actually, will have generated £1.4 billion across the individual projects that they have either provided debt, equity or pooled investment arrangements into. And you're also right, Deputy Convener, about your point about the nature of some of the investments that the Scottish National Investment Bank is engaging with, that these do tend to be not immediate startups, but also growth stage businesses. And of course, we know that the Scottish National Investment Bank isn't the only player in Scotland in this environment, and happy to say a bit more about how their work and where their position relates to those of the enterprise agencies in Scotland. We're clear from our work that we've seen, though, that the bank is investing in growth stage businesses, tending to those to be of higher risk as well, that either haven't, as organisations, been able to secure the funding that they might want from enterprise agencies, either not appropriate, or from private finance. So I think it is a factor, just before I pass to Cornelius, that their investment will be seen as offering some certainty to other investors. And the quantum of private investment into the projects that we've looked at relative to the investment that the bank has made, I think gives some credence to that. But I'll bring Cornelius in and can say more on this topic.
No, thank you, Auditor General. So I think maybe the starting point is to look at the bank's mandate, which is to invest in those high-risk businesses and projects that other lenders would normally not invest in. So that is really the test. So if we are starting from that position, most of these projects would not have happened without the bank putting in some money. And as the Auditor General said, once the bank has invested, that is actually lowering the risk levels for other investors to then come in. So this is how the crowding in is generally happening. What it means is the bank ends up carrying more risk in its portfolio than you'd normally expect of other investing institutions. but that reflects the purpose with which the bank has been set for, to invest in those very high risk, potentially high return projects that private market would normally not support.
Cornelius, is there any evidence that the Scottish National Investment Bank is, in a sense, distorting the investment market by competing with private venture capitalists, private banks, other forms of investment? Or is it working well alongside and not competing with other publicly funded organisations like the British Business Bank or the National Wealth Fund, which are available at a UK-wide level?
Yes. Yeah, I think this is something we looked at in the report, how the bank is working with other institutions. So when you look at some of the examples that we've highlighted in the report, the bank is actually co-investing with some private investors, so it is exploiting those synergies. We've seen cases where the bank has gone on to support businesses that have received early support from the enterprise agencies. It is engaging with other public investors. I think it's a core part of what the bank has done, trying to find its place in the investment market to see where it can work with others. But I think we do highlight in the report, maybe this is an area that the bank will just need to continue working on. But we do see evidence in the report of some of that already happening. But I'm sure the Auditor General will want to say something on this.
I absolutely agree with Cornelius' point. I think, effectively, we set out some of the arrangements and judgments we've made on this area, page 9 and 10 of the report, and indeed on page 11. Are they distorting the market? I think it's your direct question, Deputy Convener. To an extent, yes, they are. I think that was broadly the intention of the creation of the National Investment Bank, that they would find their place around some of the higher risk growth stage businesses. And we've looked at some of the examples, and we give one in the report of Ardis Airport, whereby the bank, I'll perhaps just kind of say a bit more about Cornelius' point about engagement with the enterprise agencies, but in that example, a joint investment with the National Wealth Fund, or as previously was the UK Infrastructure Bank. So there is sufficient evidence so far that they are working with other relevant agencies to support the delivery of both their missions and when they are complementary to other organisations. And some of the typical structures you would expect to see around that are in place. So they have a memorandum of understanding with the National Wealth Fund. We've also seen the Scottish Government mirroring actually an approach that is happening with the UK Government about putting some governance infrastructure around what's known as the Business Investment Group. So the Scottish Government supporting the work of enterprise agencies and the bank itself around that. And I think what the word that we use in the report that perhaps best sums this up is that there is an alignment between the work of the bank and enterprise agencies, as opposed to a disconnect or excessive duplication.
Okay, thank you for that. And you've obviously, from afar, you can see my questions because you preempted my next one around the Business Investment Group. And that's very positive feedback. Thank you to you both. Isn't, though, there a sense, perhaps, our job as public audit, obviously, is to scrutinise the spending of public money. And is there any sense of feeling in any of the work that you did that people are concerned that due to the high-risk nature of the activities of the bank, that they're playing fast and loose with huge sums of public money? By its very nature, some of these businesses will fail. Presumably there's a percentage of that factored into the business model. And at times when public finances are extremely tight, where cuts are being made in many areas of public services, vital lifeline services, people are looking at a quasi-private bank with 80-odd people in it, spending billions of pounds of public money. Do you think that's a concern?
So I think it's a trade-off. Actually, and I'm going to invite Catherine perhaps to talk about what a key part of our audit was to look at the investment risk management arrangements that the bank has in place. The first thing I would say, it's inherent inherently risky, that the activity that some of the bank will take. And that's by design. So they sought to position themselves to fund higher risk activity. If the opposite were true, I think we would be equally concerned in that if there were no investment losses for this organisation, we might equally ask, why not? Now, does that suggest that they haven't engaged in perhaps the more opportunistic growth opportunity-based organisations? But they have to do this style of investment with the right internal infrastructure. And we broadly found that they have, and I'll perhaps say a bit more about some of the examples and evolution of it. I'm keen to bring Catherine in, maybe just to set out some of the overall arrangements that they have in place that puts the right safeguards around in place inside the bank. Catherine.
Thanks, Auditor General. Yes, as we highlight in the report, I mean, one of the focus was to look at that investment process, and we obviously mentioned we did some case studies to test that process and how that's working in practice. I think we felt assured there is a really robust process around decision making for approving investments. The strategy is very clear about where the bank will invest, and actually mentioned obviously one of the aspects is not crowding out the private market as well as leveraging in private capital. And obviously a real focus on impact and what aligning to those missions. The bank refined criteria in 23-24, I suppose, to tighten up some of the the expectations around some of the investment financing. So, for example, that an organisation should have a revenue generating aspect. It should have enough cash to operate, and a bit of a cash runway there, and a proven management team, and various checks like that. I think it was really clear from our look at the case studies that there's good documentation around decisions there, right through from when the kind of initial consideration of something right through to the kind of final stage of investment approval. Like a strong culture of due diligence, various aspects of financial impact and risks, and lead opinion statements given on each of these. So, a very much multi-layered due diligence process at various stages. In terms of risk management, again, we found strong evidence of a culture of risk awareness, really robust risk management framework, risk registers, key performance indicators around those, and really strong reporting around those. So, I think as the Auditor General highlighted, I think for us it was to look at those foundations, to look at what was there, to look at whether that matched up to kind of what we'd say gold standard around some of this. It took assurance, as I say, tested through the case studies that we did.
That sounds very positive. Maybe some of the private banks could learn some lessons from the risk investment strategy. Can I ask just one final question? That's I did actually speak to a few organisations who had gone through the process of dealing with SNIB over the years. Did you, in your stakeholder engagement, speak to any organisations, companies that had sought investment but was denied investment, and what was the feedback they had been given? And the reason I ask for that is that has Audit Scotland identified perhaps any gaps in the market in the Scottish Government's approach to making high-risk investments, in the sense that there are very limited options available to folk when the private market says no? Auditor General, you may have watched the session we had last week with the Strategic Commercial Assets Division. We discovered, or unearthed in that session, they had made zero interventions other than ones that it inherited as an organisation when it was set up. Equally, organisations like Business Gateway, feedback I've had is that they can make small grants to people, which the SNIB doesn't, but there are limits to how much money they have access to, and SNIB clearly don't offer small or medium-sized capital funding to start-up or small businesses. So is there actually a bit of a gap in the market that SNIB's not fulfilling or could fulfil?
So in terms of, I think a number of points, Deputy Convener, I'll try and address all of those actually and bring colleagues in at various points. So paragraph 7 of the report, we set out really who we engaged with over the course of our audit work, just for completeness. So clearly we engaged with the bank, the government, the enterprise agencies, together with representatives from sector bodies to try and, I suppose, to triangulate. I think the point you've been doing yourself about how is the organisation performing, and then also drawing on some of the evidence from the survey activity about the awareness outside of the bank's offer. And again, the team can say a bit more about some of the detail of that in a moment. I think, as we say in our report, is that we generally think they found their place within what, looking outside, can appear quite a cluttered landscape at times, with a number of different enterprise organisations together with, as obviously the committee is very familiar with, the role that the Strategic Commercial Assets Division is playing. And then, not just in a Scottish context, there's also UK government-based activity also. So I think, as we've touched on to a degree, we think there is broadly an alignment, but I don't think you can ever take that for granted. I think it's appropriate that the Scottish Government is putting some convening infrastructure, if I can put it in those terms, about just making sure that this is all working as it ought to in practice. In terms of the role of the bank, as you quite rightly say, they're clear they're not a grant-giving body, and nor are they a business development based institution. They're much more what you would expect of Scotland's enterprise agencies. They've also been clear about what their, I suppose, the range of capital financing support is. So they say between £1 million and £50 million per individual investment. I think they have flexed that. I think there is, we touched on the report, there is an example where they've, for an investment, colleagues will keep me right, I think it was in affordable housing in Shetland, where they went below that threshold. But as they evolve, these are things we'll have to keep under close review in terms of the arrangements. As the report, for example, covers that the bank has remaining ambitions, and one of it to fulfil its objectives is about the extent to which it is reactive or proactive in terms of its offer. Currently, it's generally a reactive arrangement, but more recently, what we've seen is the bank, through one of its subsidiaries, has acquired Financial Conduct Authority authorisation to move into a more proactive space to advise potential clients of its offer. More activities, alignment, how it works with other organisations. Of course, all of these activities will have to be kept under really close review. But addressing your question about the feedback that we got, I'm happily turn to colleagues and say a bit more.
Thanks, General. We highlight in paragraph 23 where we spoke to representative financial sector services. And I think probably to say the bank has been on a journey about building its reputation and understanding and that wider awareness of where, its role in that kind of market. Obviously, we also reflect on the kind of the positive feedback that they had through their own stakeholder survey. And again, obviously, the operational improvements they've made on the back of some of that. But I think one of the points just to highlight was that there was obviously some feedback through those financial services sectors say, there could be points where they could take more risk to support scalable businesses, and particularly the tech sector, to improve Scotland's productivity. So there will always, of course, be feedback from various businesses who've tried to tap into that. But I think we took this, we spoke to the financial services sector almost as a representative of business directly. So, but just to say, we did reflect on the feedback there. But I think what we were looking to do is what have they done with that feedback, and have they made changes and improvements on the back of some of that, and how are they learning from that?
Thank you very much. Thank you.
Okay, thank you very much indeed. We've now got some more questions on the kind of financial basis upon which the bank is established and operates, and those are going to be put by Colin Beattie. Colin.
Thank you, Convener. General, I'd like to start just with a fairly simple question on paragraph 35. The report says that the bank's ambitions extend to taking on a more active role in the private investment market. Now, you quote engagement, advice, presumably giving advice, investment arrangement activity, and the management of third-party capital. Now, these are fairly wide-ranging skills that you need to be able to do that. I mean, I've worked in investment banking myself, and these are all each of these is a highly specialised area. How are they going to bring all the expertise together to be able to support that ambition? And how does that balance with its key role as agreed with the Scottish Government?
So I'm sure you're quite right, Mr. Beattie, actually, in terms of the skills and the affordability of some of these skills within a public sector context will be central to really the next phase of the Scottish National Investment Bank. Can it undertake this next phase of its ambition in a way that manages risk to an extent which we've seen that it broadly has done so, and as Catherine's mentioned, it's evolved its risk management arrangements. So while, as mentioned to the Deputy Convener, that Scottish Investments Limited, which is the part of the bank's group structure, is the organisation that has received Financial Conduct Authority to, I think was referring to, carry out enhanced arrangement and introductory activity within the private market, striking that balance between proactivity relative to reactive opportunities. But the next steps will have to be absolutely carefully managed. So what we haven't done in our audit in this report is to say, are they now ready to do this work? That will be central to the management arrangements of the bank, the governance, and also the Scottish Government's oversight of the bank, that these new avenues remain consistent with its overall purpose of a Scottish National Investment Bank.
I mean, when you look at elements such as giving advice, presumably advice on investing their capital, I mean, these are highly specialised, highly paid areas where people get mega bonuses and so on. How is that compatible with SNIB? And just bluntly, how can they afford it?
So fundamentally, these are questions for the bank, that they can reconcile this next stage of their ambition with a clear path of that it is deliverable, that the risk is managed, that these are new regulated activities, and the bank's not unsighted on the risks. I would say, Mr. Beattie, that they're, from what we've seen from our work so far, is that they are engaging, as we've touched on already today, in higher risk investments. They've put the makings of the right level of investment risk management infrastructure around that. But as they move into, and if they move into this new level of activity, that remains the case, something they'll have to be absolutely satisfied that they've got the right processes, the right board, the right challenge, the right people to deliver these skills. I'm sure the committee will want to touch on more widely in terms of some of the staffing arrangements. But we also, as we mentioned in our report, I think as was perhaps not unreasonably anticipated, that the more traditional public sector pay and reward arrangements might not be compatible with delivering an investment bank. And we've seen that, and that's reported transparently in the bank's annual report and accounts, that they do operate an incentive programme. They will pay more than what you'll see in other parts of the public sector. But perhaps their pay and reward arrangements might not align with what you would expect in a financial service industry. And I'm quite sure from your own expertise on this about what it would take to acquire some of these skills necessary to deliver this new stage of ambition will come at a different level of pay and reward than what you would typically expect in a Scottish public body.
It's an extremely competitive area, and there are some real big players in there. And there's a lot of questions about where SNIB might fit within the existing market, or indeed if there is a place that they can fit, if there is a niche that they can take on.
Cornelius might want to say a bit more about this actually, but I think this is the next phase for the bank, and from what we've seen from our audit work is that they have gone through these levels of consideration and development of their strategy and business plans to support its ambition to address and deliver upon its missions. So we've no evidence or no reason to doubt that at the moment, but But what we haven't done is yet audited how they are actually going to deliver upon this this level of evolution of their approach. But I'll pause. Can you please want to come in on this point?
Yes. No, I think it's probably reiterate the point you make, Mr. Beattie. There are costs to providing these services, very high cost skills, but I think the fundamental question is, what is the gap in the market that the bank is trying to fill? You're absolutely right. It's a highly competitive market. There are many businesses that are providing this. I think that is where maybe the bank could be challenged to say, well, look, what gap are we trying to address here? And does it justify us taking on those additional costs and the additional risk that comes with a public body giving such commercial advice?
I can see there's some questions for the bank. I'll move on to another question, though, because the bank's made pretty good progress towards covering its operational costs, from its own income, that is. But the ability to continue to generate that income to cover their own costs is pretty closely tied to the continuing supply of capital from the Scottish Government. How confident are you that that funding will be sustained, and what impact would there be on the bank if the capital allocations fall short?
So perhaps just to start to address to signpost Exhibit 2 on page 17 of the report that really sets out the progress that the bank has made in covering its day-to-day or operational costs relative to the income it generates. And we see in the most recent year of this audited accounts, or 23-24, that their income now exceeds their operating costs. That's real progress. You know, so income from the bank will be generated from investment income, arrangement fees, and so forth. But as I think we've touched on with the Deputy Convener, Mr. Beattie, that the change or uncertainty around the volume of financial transactions, which have been the primary source of the bank's capitalisation.
So yes.
Are you happy for me to continue?
Yeah, I'm happy for you to continue. Yes, it all makes hangs together.
I think they do. They're absolutely intrinsically related. That if the bank's capitalisation doesn't continue as its financial strategy assumes, and if that was based on financial transactions, the question for the bank and really for the Scottish Government will be, does it find an alternative way to continue capitalising the bank, or is it going to reduce its allocations or find some other approach for the bank to deliver this? These are the key decisions that now await government and the bank and its board. So I think there is risk to its ability to become that perpetual investment fund. And depending on the outcome of UK Government's consideration, the spending review, the Scottish Government's medium-term financial strategy, and then, of course, the 26-27 Scottish budget, that will give the real evidence of what the direction of travel is for, I think, probably not just next year, but years to come, about whether the bank will be capitalised as intended. It will cover itself, its running costs from its income, and it can become ultimately that perpetual investment fund that it was envisaged to do.
Now, financial transactions, if I recall correctly, have already been reduced somewhat over the last few years. And I think most of them now go to the bank, don't they?
Yeah, Cornelius can come in, actually. Yes, that's right. I mean, financial transactions, the essence of these, they would be capital that would go outside of the Scottish or the UK public sector bodies. So typically to support government activities or interests, but not delivered directly by public bodies. And I think that's consistent with what you're seeing in the bank. So they have reduced, but I think what's also the case is that the bank's provision of financial transactions has been more protected than other parts of the Scottish budget. And as we mentioned in the report, for example, that the affordable housing supply programme, at paragraph 39, that's position in the Scottish budget hasn't been protected as much as the bank. But we're clearly at a real decision point now.
Just to explore a little bit further about the financial transactions, they're obviously not a grant. They're not part of the block grant or anything. They have to be repaid. So the obligation is on the Scottish Government to make the repayment. Is there any back-to-back agreement with SNIB in connection with that?
Just might want to pick that up actually, just in terms of how that works. But I think what you're describing is that as investments end or are repaid, they're not held by SNIB. So the bank will have to; those will be returned ultimately to the Scottish Government and UK Government. So until that is resolved, and there is a dispensation from HM Treasury, that's really the fundamental point I think the bank is making, and we've set out in today's report. It won't be in a position to have that level of clarity around its perpetual investment fund, cover its operating costs, and to invest perhaps at a different level of pace than we've seen thus far.
But what are the implications there? The financial transactions have to be repaid. That obligation is on the Scottish Government, not necessarily on SNIB, unless, as I say, there's a back-to-back agreement on that. But what is likely is that as these transactions come to maturity, then that will effectively reduce the capital of SNIB, because they will have to return that money to the Scottish Government. So that will impact on future investment. And I just wonder, given the fact that financial transactions have been there over several years now, the cumulative effect of these payments down the line could be quite significant.
Yeah, can you just want to touch on this?
Yes, I think the way we've understood it is when the Scottish Government receives financial transactions, as Auditor General said, they are invested normally in a body that is outside of government, and that investment transaction creates a financial asset that is sitting outside of government. So yes, the Scottish Government has spent the money, but there's a financial asset that the Scottish Government owns, which is sitting outside of the bank. So it's when that asset matures, in the sense that it is disposed, in which case, in the case of the bank, it's either the bank gets back its capital, that the settlement with Treasury then happens, the money then flows back to the Scottish Government and back to Treasury. So before that happens, there is an asset that is sitting outside of government, which you can associate with that spend. You could almost say there isn't a net change in government's debt position in that case, because while government is spent, it is also holding an asset against that spend. It's a very complex technical point, but the use of financial transactions basically is to give government greater flexibility on how it manages its debt, because these financial assets can be quickly disposed if needed, and the money is then returned to Treasury to cover government debt.
What happens if the asset you're talking about becomes impaired?
I think that is where the big risk comes, and I think we've already seen some of that happening. So if it becomes impaired, currently the bank has to cover those losses from its income. If it's not able to cover the losses from its income, then there's a call on the Scottish Government budget, so that risk then extends to the Scottish Government in that way. And again, this is where it becomes really critical for the bank. How is it managing that risk-retain trade-off? So if it is going to be carrying a lot of risk, which will result in more assets getting impaired, and it's not able to cover that from the income it is generating, then there's a call on the Scottish Government. That's where it becomes a real liability for government to cover those losses.
And given that the whole purpose of the Scottish National Investment Bank is to take on higher risk assets, the risk is going to be itself higher, that you're going to end up with impaired assets. It's part of its job.
That is absolutely right. And I think this is the point the Auditor General was highlighting earlier, that we have to recognize that in accepting an institution like the bank, we've accepted that the public sector carries that level of risk. How much risk are we actually willing to accept? It really becomes a policy question. We wouldn't want to make a judgment there, but I think those are the real challenges around investment decision making that the bank needs to be working on. I think we were sure that they have the right systems to deal with that, but those are the real life challenges really around having such an institution sitting within the public sector.
From what you're saying, the bank is aware of these risks, and to the extent it can, it's managing them.
I think that's a fair assessment. Yes, they are aware of it, and they are engaging with their sole shareholder, the Scottish Government, to try and find a resolution to it. I don't wish to temper any enthusiasm, Mr. Beattie, on it, but these issues were known about when the bank was established. So clearly they are complicated. They will require the support, dispensation from HM Treasury to find a resolution from it, and we make that clear in the recommendation in today's report.
Okay, let me move on just to one final question, which has kind of been touched on already. Obviously, annual budget rules affect the bank's ability to plan long term. And when you're doing investments, long term is what you're trying to do, because part of the responsibility of the bank is to provide patient capital. Can you tell us a little bit more about how the accounting rules impact on this? And are you aware of engagement between the bank's leaders and the Scottish ministers to provide any increased flexibility? Because it's difficult for a bank to operate within these sort of rigid rules.
Yeah, I think it's clear it is challenging for the bank to function as a public body whilst trying to operate as a lender. And as we mentioned in the report and touched on already this morning, that the Scottish Government has acknowledged particularly the bank's ambition for year-end flexibility, to find an appropriate mechanism that can help it manage its capital allocations and investment in a more open-ended basis than public sector accounting rules allow for. What we don't know yet is what that means, what the detail of that, what timescale is being operated to. But it's key to find I think, first of all, provide clarity on it. So if it can be overcome, to set that out. But if it can't, just to be clear in that's the arrangement that the bank has to operate in. It will be bound by annual capital allocations, spends what it deems to be appropriate, and then other amounts that come in future years are dependent on what the Scottish budget dictates. But I think the lack of clarity is unhelpful, and I think it probably felt like that's been going on for a while now, Mr. Beattie, to see. But that there is acknowledgement from the government, and also not just from ministers. I think it's been a feature of some of the recent discussions in the relatively recently established ministerial advisory group that's part of the Scottish Government's arrangements, that has also been considering how funding might work. So I think there's absolutely clarity on that this is a matter to be resolved, but what I don't know to share with you today is how or when that will be done.
Just one last point maybe you can clarify. The bank receives an allocation for year one. We know that drawdowns take place over a period which crosses the annual budgeting period. I presume there's mechanisms in place that any unallocated capital that's issued, that's given in year one, can roll over to year two.
So I think that depends on
That's unallocated.
Yeah, I think it depends on the Scottish Parliament, the Scottish budget, for the allocation of capital funding. And I think that's really the root of the issue, that there isn't a reserve, that they can't draw down and hold it. They have to draw down and invest when required. And I think that really speaks to the point that the totality of the capital allocations, like the right paragraph, I think it kind of illustrates it quite well on Exhibit 1 on page 16, that total capital allocations, if we include 25-26 of £1,118,000,000 relative to a spend of 700 or a committed capital of £785 million. Those two figures will never align exactly, but I think it speaks to the point in the feedback that we got from the bank that not having that flexibility between financial years is very much part of the issue that they wish to be addressed.
Okay.
Cornelius, you want to come in?
Yeah, no, I just wanted to maybe illustrate the practical implications of this. It impacts on capital utilization, and that discrepancy between the 1.1 billion and the nearly 800 billion that the bank has actually committed is an illustration of that. So I think there are two things happening here, because the bank cannot anticipate with confidence how much capital it will have going forward. It limits its ability to develop a pipeline of investable projects. But also, as you say, there are multi-year disbursements for projects that have already been committed to. So it means the capital is going to receive, say, next year, is already drawn down by projects it has committed to in previous years. That then leaves the bank with actually very limited headroom to put into new projects. So it's a huge, I think, handicap in the bank's ability to fully utilize the capital that is just being allocated. That's really the implication of that issue, which is really a fundamental constraint to how the bank is operating at the moment.
Okay, thank you. I'm going to bring Stuart McMillan in a second or two on governance and accountability. But before I do, can I just go back to something you mentioned a few minutes ago, which was the newly established Scottish Government Ministerial Advisory Group. In the report, you also refer to a body established in January of this year, which was under the Directorate of the International Trade and Investment section of the Scottish Government, which is a business investment group, which is comprised of, as I understand it, Scottish Government policy advisors, representatives from the Scottish National Investment Bank, and representatives from the three enterprise agencies. Is there a danger of over-governance, of a cluttering of lines of accountability that are going to make it actually more difficult to understand where decisions are being made and where direction is coming from?
That's a real risk to be managed, Convener. That I guess I might even have used the phrase already about there are a number of organisations who are active in a Scottish context and more widely across the UK as public bodies investing out or grant giving to support economic growth. And this is really what we're talking about. I don't think you can ever take for granted that it's operating well. So that there's some newly established infrastructure. First of all, the Business Investment Group under the Director for Investment International Trade, bringing together these partners to ensure that alignment is working properly. And then the other point about the Ministerial Advisory Group, also now relatively recently established, as was required of the founding legislation, to support ministers, to advise them on the work of the bank. I think it's always that right balance between overreach and insufficient interest and exercise of understanding of how governance is performing. I think our audit work has satisfied ourselves that that balance is in place currently, that the bank is well governed. It has appropriate internal governance arrangements. Its shareholder, sole shareholder, the Scottish Government, is able to observe board meetings, discussions, but again, not seeing evidence of either a lack of interest or overreach. But I agree with the point you made. I don't think you can ever take this for granted, and especially when you're dealing with such a complicated environment with multiple organisations present, I think it will require constant triangulation that these arrangements are operating well.
Okay, and just in the interests of transparency, do we know whether these newly established groups publish their agendas, publish minutes of their meetings that are in the public domain? Do we know exactly what each of their terms of reference are?
So I'll ask colleagues to talk about the Business Investment Group, but on the Ministerial Advisory Group, that is the case, yes. So since it's been established, it's the list of members is in the public domain, as are its terms of reference, and it's the minutes. I think it's 2 meetings that have been published, so they're available on the Scottish Government's website. But in terms of the Business Investment Group?
I think the Business Investment Group is very much an internal kind of working group, and it was very much welcomed by, when we spoke with representatives of the enterprise agencies, very much welcomed by them. It's more a forum to discuss that kind of collective market analysis and ensure that, they have obviously their formal engagement routes, but to ensure each agency is working and adding value as best they can in the market. So that is an internal group, and the minutes aren't published of that one.
Okay, well, thanks for clearing that up. I'm going to now invite Stuart McMillan to put some questions to you. Stuart.
Thank you, Convener. I generally want to echo the comments of the Deputy Convener, certainly picking up this report. Certainly, Section 20, bullet point 2, the overall positivity about the bank increased from 68% to 83%. Section 27 demonstrates a culture of continuous improvement. Section 72, the sound oversight arrangements. 89, the improvements in the content and presentation, and there are other sections as well where it's a report that does highlight that this is an organisation that appears to be doing well in terms of governance. I will come back to a point my colleague Colin Beattie touched upon. That was regarding sections 21 and section 47 on the issue of risk. It certainly kind of struck me that it's an organisation that is very cautious, notwithstanding the financial straitjacket that it has to work under. But in terms of risk, it does appear that it's focused. It's trying to provide a certainty for business investment, and it's not prepared to go out on a limb. Would that be an accurate assessment?
So on those points, Mr McMillan, I think, as I mentioned to Deputy Convener, we're evidence-led. So the judgments that we've made, in our view, have been supported by the material and evidence and the sources with which we came across during our audit. The nature of the organisation is one that inevitably it will encounter risk, and it has to strike that balance. It is an organisation that is investing in higher risk activities with scaling up phases of business growth. And it has to make sure that it's got the right internal infrastructure to make these decisions and then monitor them as the investments progress through to maturity and, in due course, exit arrangements. I think as Catherine's touched on, and maybe just again perhaps to highlight to the committee, page 25, Exhibit 4, where we set out really the investment decision-making framework that exists, and then taking a view, is that as it ought to be? So I'm not sure I would entirely share your characterisation of that as cautious. If anything, I think it has to strike the right balance, that it's appropriate for the type of organisation that it is. The thing, maybe just to turn to Kirsty in a moment, actually, about how all of that is operating, both in terms of how investment decisions are made, the communication of some of those investment decisions, and then also the point about you made, stakeholder feedback was that the pace of some of those investment decisions could be higher. But that's coming against a backdrop of positive feedback from stakeholders more generally. Kirsty.
Thanks, Auditor General. So yeah, picking up on the point there about the communication of investment decisions, as Catherine has already talked to the investment structure and the work we did around the case studies, we find that there was a really clear rationale. There was a lot of information in there and a lot of consideration about why an investment was being taken forward and the decision to make that investment, both in terms of the more commercial aspects around the finances, but also in terms of the impact that was expected to be delivered through that investment. So we've made the recommendation in the report that the bank could go further in explaining that when it is making its investments public. While we absolutely recognise it needs to balance any business or commercial sensitivities, it could just help explain a little bit more to make it clearer why certain investments are taken forward and what the expected impact is. So therefore kind of telling its story a little bit more to the public and helping people understand why certain investments are made and helping explain that kind of process so that people are a bit more assured publicly about the process it goes through and the things it considers in making those decisions. Thanks.
Okay, no, that's helpful. Just in terms of that, obviously that's a recommendation in this report. Has that been put to SNIB already in discussions between yourselves and them, and are they receptive?
Yeah, so they have. They have seen the report now and talked to us with it. I think they are receptive. That, in fact, we have seen there are some good examples so far of when they have communicated publicly. They've included things like short videos to try and explain and contextualise the investments. Some information about local context of why they've made that decision. One that we highlight in the report is the decision to invest in the mid-market housing in Shetland, which was a little out with its normal range of investments. So it went a little bit further to try and explain that. So it's really encouraging the bank to consider where it can follow some of those good examples it has got in setting out a little bit more across its range of investments. But yes, it does seem receptive to that.
Okay. Just on the advisory group that was touched upon by the convener, so has there been any indication regarding the impact of that advisory group on SNIB's future direction?
I don't think we have that detail yet. I think it's early days for the ministerial advisory. As I said to the convener, Mr Millen, they've only had two meetings that have been published. I think, having looked at the most recent set of minutes in their forward work programme, it suggests that, which is welcome, I think, consideration of our report, and then also consideration of the bank's relatively recently published impact report. So not taking a view about their work, but I think it remains to be seen yet, and perhaps an area for ministers or government to give a view about whether they think that advisory group is working as intended. And it's one that we'll give consideration to as we move forward with our own work.
Excuse me, do you have any indication as to why it took a fairly lengthy period of time before that met?
I'm only really drawing on, I think, some of the material that's available on the Scottish Government's website, is that they took a view that they wanted to wait until the bank had established and was beginning to show its own impact before forming a ministerial advisory group, as was required by the legislation. Could they have done it sooner? Probably. But I think it's an indication that and it's perhaps too early to take a definitive view, that the material that they put in the public domain about their interest and their activity looked to be consistent with what you might expect an advisory group to undertake. But I suspect it's more a question for government themselves about why they took as long as they did to set it up.
Okay. You've already touched upon exhibit number 4 at page 25. And also this outlines the process for the bank's investment decisions. And also that's without the Scottish Government involvement. So how robust are the safeguards in place to maintain this independence?
You're quite right in terms of the point, though. The bank is very clear that it operates independently from government, its sole shareholder, and I think those things can be true, even the point discussed with the convener earlier, that the bank is represented or observes its board meetings. So, but within the bank, we've also seen, and colleagues can say a bit more about how this operates, the safeguards that they themselves have put in place to satisfy that there are not any ethical challenges, that independence is operating as intended. But I think, even in evidence to parliamentary committees from the Chief Executive and the Chair of the Bank, they are very clear in asserting their independence. It is the bank, its investment committee and its board that will take decisions rather than the Scottish Government as shareholder. But I'll pause and bring Catherine in just to set that out in a bit more detail.
Yeah, I think we highlight in the reporting the selection process really is based on the bank's criterion, and through our case studies we found no evidence of any involvement in the bank in that process. Of course, the missions that the bank have align to government policy, but indeed, I suppose, in terms of there's a clear distinction between those and the bank's, I suppose, the management of the bank. There's the shareholder team, as we said, that sound arrangements there in terms of reporting. But yes, overall, no evidence of political consideration in any of those the documents that we looked at in terms of the case studies. I think a really key point as well is for the bank around private sector confidence is really important as part of this process. So that's something they're very keen to be transparent about, and of course as well around leveraging in other private sector capital as well. So yeah, just I suppose to highlight that's a key thing for them.
Okay, thank you. Just on the target rate of return, that's between 3 and 4% across its portfolio. Can you provide some further information with regards to the mechanism and how this will actually be measured and also reported on?
Certainly, I'll maybe start with a bit of background to that, and I'll bring colleagues in just to see how that's performed. Effectively, this is, as you say, Mr McMillan, this is what is the bank generating from its investments in terms of financial return, alongside the application or achievement of its missions. From looking at some of the material in terms of the implementation plan for the bank, this was clear that setting a rate of return with appropriate reference to international comparators, percentage of GDP investment at 3 to 4% is broadly what was anticipated as a target rate of return. Whether the bank is achieving that yet, I think there's a distance to go yet, probably reflecting its evolution of its maturity as an organisation. And that's something I think probably is going to take a number of years now, perhaps really the first 10 years of its operation before it can be satisfied that its investments are delivering both financially and wider impact basis. But I'll turn to colleagues if they want to say a bit more on this point.
I think that's probably the main issue, Auditor General. It's too early to judge whether the bank is on course on hitting that target. I mean, the portfolio, if you look at it, it's still very small, 47 projects. They've only invested less than half of the capital that the Scottish Government is committed to provide. So I think in these early years, 5 years since the bank was established feels like a long time, but I think it would be too early to make a judgment on how they are performing on that long-term target on rate of return.
Okay, and in terms of kind of international comparisons, and certainly also kind of within the UK as well, like so the British Business Bank, is it faring comparatively? Or is it too early to say so far?
I guess I'm reluctant to give you assurance on it at this stage. I think it'll be for the bank to evidence its impact, and it's doing so through its impact reporting. As I alluded to earlier, they published their latest impact report in the past couple of weeks to kind of set out their progress towards delivering upon their missions, the extent of capitalisation, and progress and some of the wider objectives are consistent with job creation, carbon reduction and so forth. The extent to which that is where they need it to be relative to international comparators. I think it's more of an area for the bank themselves to address where appropriate. I think to an extent what we've seen from our own work is that there's quite a wide, varied picture in terms of even, not just in Scotland, but even across the UK, about what these different public sector financial institutions are doing. That the Scottish Government has set up the plan just to kind of take stock of how the connections are working as appropriate, but on a UK basis, they're perhaps doing something a bit more fundamental, looking at satisfy themselves at how all these arrangements are working in totality. But I think fundamentally it's a matter for the bank themselves to satisfy stakeholders, Parliament, that they are operating as intended, and that's consistent where appropriate with international comparators.
With regards to the Scottish Government's sponsorship role, how content are you with that? I know that's obviously something that's come up in previous meetings in this committee.
Yeah, it certainly has been a feature of, indeed, much of my own reporting in terms of the adequacy of sponsorship, and indeed the committee's own investigations about how that fundamentally hasn't been working really as intended in some other organisations. So I think it's welcome. That's not what we've seen here. We've seen sponsorship appropriately discharged by the Scottish Government. That's the feedback that we got from both the bank and the Scottish Government teams that we spoke to during the course of the audit. And it's really at the heart of how this organisation operates. So it's got one shareholder, who's the Scottish Government, and but it's also aligned with a bank that is very protective of its independence. So it asserts clearly and provided appropriate evidence that it is the bank that is making the investment decisions. But it's engaging with its sponsorship team as appropriate. And as I mentioned once or twice already, that the shareholder or the sponsor team is observing board meetings as appropriate engagement with executives and non-executives. We now have a ministerial advisory group in place. So it's complicated, but it seems to be working.
Okay. And page 33, Exhibit 7. There are 27 local authority areas that are covered. Obviously, 5 aren't. Which are those 5?
So those 5, actually, and I do know this, is so it's set out in detail. The committee are interested, not in our own report, but in the bank's impact report. So these are the 5 areas that are not referred to: are Eastern Bartonshire, East Renfrewshire, Falkirk, Clackmannanshire, and the Corla Western Isles Council are the 5 local authority areas that haven't been identified as locations that have received investment from the bank.
That's helpful. Thank you very much. Thank you.
Thank you very much indeed. Can I follow on from that and ask you, in paragraph 91 of the report, you give a very precise figure. You say that 92.3% of direct investees are small and medium-sized enterprises. Whose figure is that, and how is it derived? So this will be a figure that the bank has produced, convener. But I'll just give, I think Catherine's maybe got the detail of the nature of that calculation.
Thanks, Chair. Yes, it's from the bank's annual report. And they do, I don't have it to hand, but do set out the criteria for what is an SME, so it's cash runway and that sort of thing. So, but yeah, it's directly from them.
It's a very precise figure, isn't it? 92.3%. And I have to say, when I look at the quantum of investments that have been awarded since the bank was established, if I look at the 3 biggest, the maximum £50 million investments, one goes to North Star Shipping Renewables, based in Aberdeen, fair enough. But amongst the others, £50 million went to the Ardassia Port, which you've referenced already, which is owned by a venture capital company based in Houston, Texas. Gresham House Forestry Fund, which has been raised in Parliament before, has been quite a controversial investment. is now owned by a private equity company based in Fifth Avenue, New York. So, I mean, it seems to me that, and maybe this is just a fact of life, but it seems to me that actually quite a large amount of investment decisions by the Scottish National Investment Bank have gone to big private equity-owned international funds rather than to SMEs that are, you know, trying to grow their business in the terrain of the Scottish economy.
So the examples you give are all accurate, Convener. We've seen some of the detail of those and indeed, of course, as you mentioned, parliamentary interest in some of those investments. I think what we looked to do in the audit was to be clear about, is the bank delivering its purpose? Were there any exclusions about the extent to which where it could or couldn't invest and how that was being structured? And we haven't found that. And some of these events, I would say, have occurred after the original investment has taken place. So you mentioned the Gresham House ownership transaction or ownership change took place after the bank's original investment. I think it perhaps goes back to some of the point, and we haven't touched on in all that much detail yet this morning, is that impact about what the bank wants to achieve rather than the initial investment arrangements, and particularly looking at what is it getting, how is it delivering upon its missions. Key one for those is, you know, some of the side benefits that you would expect is job creation, high value jobs, and where are those being delivered, as opposed to who are the ownership of whether it's large organisations relative to SMEs. So we're conscious of those circumstances, Convener, absolutely, and kind of note the bank's reporting of SME as opposed to some of the large-scale investment. But I think I would maybe just echo Cornelius's point more generally that it probably feels early days for some of these investments to make a definitive judgment about whether it's a SME or larger scale style of investment that the bank is looking to undertake.
Starting point is, you quote in the report a figure which you say is an echo of an investment bank figure, that 92.3% of investees are SMEs, and I think I'm challenging that as a likely reliable figure. I think the other thing, if you look at the Gresham House Forestry Fund, and when the investment was first announced in August 2021, certainly then I went onto their website to look at how they positioned themselves as a business, and they were largely selling forestry investment as a way of avoiding paying inheritance tax, paying capital gains tax. So is there any kind of ethical filter applied to these investment decisions?
Yeah, and I'll bring Catherine in again to say a bit about some of the, as I mentioned, Mr McMillan, some of the ethical and primarily avoiding conflict of interests in terms of the bank's investments. But fundamentally, the bank has set out and asserted it is there to deliver upon its objectives, overarched by its three missions, Convener, of investment in technology and impact, climate and place. So the barriers to that in terms of will it invest in particular industries or organisations, yes, it's got criteria upon those as well. So, for example, it said that it won't be investing in tobacco, will not be investing in armaments organisations. So there is something of a framework. Whether that translates directly to say, and it will not be investing in a particular ownership structure, or what it means if there's a change of ownership during the course of an investment, is something I'll pass on to Catherine. If we don't know that detail, we can certainly look further, but it may be something that the bank themselves can provide that to the committee.
Not too much further to add on that. Thank you. Just, I guess, in terms of that due diligence that's carried out at the early stages, there are obviously ethical considerations considered as part of that. In terms of the kind of conflict issues as well, we did find, strong evidence of, obviously there's a real perceived, there's a real recognition of perceived and real conflicts of interest, particularly, I guess, with many non-executive directors having, either current or previous employment in private sector financing. And they have in place policies relating to conflicts, including code of conduct and conflicts of interest and that sort of thing. But in terms of individual investments, yes, I think we'd have to look to see the categorisation. Just in terms of the SME, I was just having a quick look to see if I had any further information on how they've categorised those, but I think that's maybe something we could come back on just to clarify. We did check the definition of SME when we quoted that figure in the report.
I mean, I think that probably quite a number of us might feel that an organisation whose raison d'etre seems to be to help its clients avoid paying tax should not necessarily be benefiting from public funding to aid their venture. I mean, it just, you know, I'm not talking about individual directors' conflicts of interest. I'm talking about a conflict of interest between the organisation and its purpose and its resort to use of public funds. I mean, the other thing about before I move on to something else, I mean, the other thing about the Gresham House Forestry Fund, which is of note, isn't it, is that they say, or it's said by the investment bank, 60% of their investments will be in Scotland. Presumably, therefore, I would deduce at least 40% are going to be investments elsewhere. I think it's elsewhere in the UK, to be fair, but they're not going to be in Scotland. I mean, is that not subject to some kind of evaluation when decisions have been made about where investments have been placed?
Yes, indeed, Convener. I think ultimately this will be framed by the bank's investment policy, and I've mentioned one or two aspects of that in terms of the clarity with which they say where the types of industries they will not invest in, so arms manufacturing, tobacco. But I think if I step back for a second, what are they trying to achieve from their investments? Yes, the delivery of the mission, but also financial return. You know, they're looking to achieve, covering their income, produce growth in the economy. And I think the analogy I perhaps make to other public-style institutions that also invest, so local government pension schemes, for example, will also be investing not just in Scotland or UK, but internationally to derive return and benefit. So I think it's understanding the bank's clarity of its decision-making and its framework for those decisions that are really clear. And I've got Cornelius wants to come in about just a bit some of that detail.
Thank you, Auditor General. Yes, I think the 60%, you're right, Convener, that is what was expected to be, or rather targeted to be invested in Scotland. But I think we need to look at 60% of what. So our reading was the bank was investing in the Forest Growth and Sustainability Fund, which was supposed to be 300 million. So it's actually the 60% of the 300 million is our reading, what was going to be invested in Scotland. Now the bank only put in 50 million into that. So when you look at the equation, it's actually leveraged more investment into Scotland. Whether that is what is actually transpired, we haven't looked at that to form a judgment. But actually, when you look at the closer detail, actually more funds could have come into Scotland than the bank has actually put into the 300 million fund. I mean, the other thing to highlight, rather to emphasize, is what the Auditor General is saying. The bank here has invested in a fund, a pooled fund with other investors. The nature of these funds is you've got no control over what happens to the overall fund, and I think that is maybe one of the risks that the bank and government has taken by accepting that the bank can put money in these funds. Is that right or wrong? I think it is really a policy question, maybe for Scottish Government and the bank to consider.
Yeah, okay. I mean, if I could just move on to a more positive investment, in my view, and it's been referred to a couple of times already, which was the investment into the construction company that was building housing in the Shetland Isles. In the report, you mentioned the fact that one of the attractions of that investment, albeit below the normal threshold for investments, was that it was converting to being an employee-owned business. So again, is the ownership structure, is the way in which the business is put together a factor in determining where investment is placed?
I think what you're referring to is there is discretion in the bank convener in terms of the range of factors with which they will make an investment decision with the overarching nature of missions and organisational objectives. I'll bring Kirsty in if you want to add about the Shetland investment in particular.
Thank you. So on the Shetland investment example that we've given, they specifically set out some of that rationale to communicate why they went out with the normal range of investment that they set out in their investment strategy, so between 1 million and 50 million. So that's why we saw a little bit further evidencing and explanation about why, like the rationale for making that decision. And again, that links back to one of our recommendations about explaining those decisions more, so even when it is within the kind of core structure of its investment strategy, setting out some of those things that the bank considers could help tell that story more clearly where they have thought about other aspects of the business. But as the Auditor General says, I think it's a range of factors, and that's what we've seen in the case study review. They have options to look at different things and balance across impact considerations, risk considerations and financial considerations, and those will be slightly different for each investment depending on the context. But it is helpful when they do explain that little bit further so that people can understand their thinking.
It goes to one of your recommendations about transparency, doesn't it?
I think it's trying to do all these things, isn't it? You know, so to invest successfully, but also give itself a degree of discretion and leeway. But the risk, of course, of that is that it rubs up against transparency and clarity for why it invests in a particular area. And as Kirsty rightly mentions, I think that was one of the things that came apparent during the course of the audit, that stakeholders weren't always immediately clear why that investment, and although they don't report which investments they don't engage in, there'll obviously be a market understanding, and indeed maybe among members of the committee, about where an organisation has sought investment but didn't get it. And just if there is that, although we say in the report quite clearly that it's found its place, that won't inevitably satisfy everybody if they've not been successful for an investment, whereas they think an organisation similar to them has.
Okay, final question from me before I bring Graham Simpson in. And that's just, so one of the vehicles for investment is taking out an equity stake. I think that's one of the options the bank has got, hasn't it? So my question is, are there examples of that? And where equity stakes have been taken out, is there then a nominated person from the investment bank on the board of that organisation?
Yeah, I'll bring colleagues in actually just to say a bit more about how that works. Convener, but perhaps you're right, the bank has three main ways with which it will structure its investment finance. So first one is debt, so it lends money to an organisation and generates a return with agreed interest on it. The second is equity, which again, similarly not an uncommon approach to investing. And the third being, as Cornelius has mentioned, some of perhaps the Gresham House example, it's a pooled investment in a particular fund approach. In terms of the arrangements thereafter for equity investment, I can turn to colleagues actually just to kind of set that out in a bit of detail for the committee. Cornelius?
Yes, so I think this is probably one we might need to come back to you, convener, given we didn't do detailed follow-up on individual investments to look at arrangements. I don't think that comes out in the report, but I think it is an important point to understand who then represents the bank where it's holding equity. Unless my colleagues have something to say, I think it's something we can come back to you in writing.
Yeah, sorry about that, Convener. I think we perhaps not anticipated that line of question, but certainly we can check our records and come back to you in detail.
Okay, right. Thanks a lot. That's absolutely fine. I'm conscious of the time, but we've got one final line of questioning, which is going to be prosecuted by Graham Simpson. Graham.
Thanks a lot, Convener. I just want to actually follow on from the Convener's last line of questioning. I don't know if you're a fan of the TV programme Dragon's Den, but I am. And one of the questions the investors often ask is, how will I get a return on my money if I invest in you? So they're thinking of an exit strategy. So does the investment bank ask that kind of question when it's making these investments? because ultimately they need to get a return.
So, well, I'm familiar with the programme, Mr Simpson, first of all, actually, and absolutely aware of the nature of that type of investment. And while I think there are parallels to the Scottish National Investment Bank, but I think what's clear from the material, and indeed Mr Beattie mentioned this phrase earlier, this is patient finance. So this is not an investment for a quick flip of return, but more aligned to consistency with the missions and the overall objectives. Again, I think of interest to the committee, I hope actually really what we look to do at Exhibit 4 is to set out almost the flowchart of how this operates with stage 1 of the investment new business forum, where on a weekly basis within the bank, the relevant people will say, here's a particular opportunity that we're aware of. We've already touched on to an extent this morning that that tends to be on a reactive basis for the bank. And in order to that feel more rounded, that they've got the balance between a reactive opportunity of people approaching the bank as opposed to them proffering opportunities of their services to potential investees on a proactive basis, they've had to get Financial Conduct Authority authorisation for that additional part of their offer. So I think what we're seeing is that they have an investment strategy, an approach, the right governance around that, but evolving where they want to go next so that they get the return of their choosing and is in line with the expectations when they make that initial investment.
But when they make the investment, have they got an exit strategy? Because let's say you put £10 million in, you're not going to want, well, A, you're not going to want to lose money, but B, you actually want to make a profit on that. So do you think they've got a plan to do that with their various investments?
I think I'm clear in that, and the team can say more about whether it's the case studies or in the round an example, that's absolutely inherent in how a national investment bank will operate. This is not an open-ended. If it were, that's a grant. That's, if you're not going to get your investment back, then that's perhaps more aligned to the style of business support that you might see from some aspects of the work that enterprise agencies will do. But again, happy to pause if the colleagues wanted to say a bit more about some of the detail of how that operates.
Thank you. It was just to echo kind of what the Auditor General had said there. We saw that consideration of the financial case for the investment as an inherent part of the built into the entire investment process. So it's considered right from the start to the end with clear reporting of that through each stage and clear consideration of the financial considerations of what that the commercial viability essentially of that investment process. What that looks like on each individual investment will be different because it's balanced at a portfolio level across the full investment range of the bank to support its kind of target rate of return and its achievement in that space. But it's absolutely a consideration from start to finish through the investment decision-making process. Yeah.
An example that investments evolve and change. So in the appendix to today's report, page 38, we give one of the innovation case studies, which is about Orbex, a satellite launch company. And so the bank made an initial investment in 22 of £17.8 million in equity investment. And then as the organisation changes, it's had a further investment from the bank to support its business strategy. There's kind of change in where satellites could be launched in different parts of Scotland. So I think probably that illustrates that it will be a bit horses for courses, about whether the timescales will likely change for when that investment would initially have been thought to mature relative to the subsequent investment would take place. But Kirsty's right. I think it's clear that the initial investment would have an anticipated return an investment exit date along with what will be achieved during the course of the investment in terms of wider mission objectives.
Okay. Now, obviously, we've discussed already that there are risks, there are inherent risks, and when you're investing in companies that are deemed high risk, there's going to be winners and losers. One of the biggest losers in terms of investments made by SNIB so far, well, probably the biggest, was its investment in Circularity Scotland. Now, you've already said repeatedly that the bank values, it sees itself as independent, doesn't like political interference, it would say it doesn't have political interference. But Circularity Scotland was set up in the wake of the deposit return scheme, a government scheme. So do you think there was a risk when they decided to invest all this money in Circularity Scotland that it could be at least perceived that there was an element of politics in that investment?
So I do recognise that, and I think that's very much the parliamentary scrutiny that the chair of the board was subject to and addressed, and evidence taken, I think, by both the Economy and Fair Work Committee and the Net Zero Energy and Transport Committee when it looked at this matter. That was there pressure brought to bear upon the bank to make this investment. And you'll see, Mr Simpson, from our report today, we do have a case study on the bank's investment in Circularity Scotland, the arrangements leading to its investment. And you're right that it's the only loss the bank has declared to date following the failure of Circularity Scotland, following the delay to the implementation of the deposit return scheme in Scotland. The bank's been absolutely clear in asserting its independence, that it wasn't subject to political interference in the nature of that investment. That was a decision that the bank themselves took. I've got a couple of factors I would point to. One is that Scottish National Investment Bank wasn't the only investor that lost money in this, that there were other investors, notably the Bank of Scotland, also lost money. We also note that the chief executive of the bank, who wasn't employed at the time when the initial investment was made in Circularity Scotland, undertook a review of arrangements. He's also reported that they were robust, but not perfect. And I think one of the things that I think is reasonable to highlight is the bank hadn't adequately considered the risk of legislative change in the event of their investment, and that's clearly what then materialised. So I recognise the points that you make, and indeed that this has been subject to parliamentary scrutiny already.
And I was on the Economy and Fair Work Committee when we looked at this in June 2023, and I put it to the chair of the board, Willie Watt, that this had demonstrated a lack of due diligence. They hadn't thought things through. He told me then, sometimes people make mistakes, sometimes people get things wrong, and sometimes the facts turn out to be different from what they thought they would be. And he also said the bank will make losses on investments. Well, we know that. Do you think they've learned any lessons from that calamitous investment?
I think a few things, if I may, actually, and I'll bring Cornelius in just add a bit of detail if he wishes. That they have undertaken a review by a senior leader in the organisation who wasn't present, I think was the right thing to do, and that they've identified that there were matters they could improve upon is also welcome. So particularly the point we've just discussed about legislative or regulatory change not being adequately factored into their decision making at the time they made the investment, and that it now is welcome. But equally, the point that you make is that there will continue to be investments that the Scottish National Investment Bank make that will not generate either a return or it will be lost completely. I think we just have to expect that, and that feels uncomfortable because this is public money. You know, none of us would want to see public money being lost, and inevitably, given some of the scale of investments that Scottish National Investment Bank makes, these will be millions of pounds that will be lost each time they are unsuccessful. I think we should hold off making definitive judgments about the success of this until we're clearly through what would be the initial patient investment approach that the bank is making before deriving a long-term view. And that's what we've tried to do in today's report. We've said that the bank has made a good start to its arrangements, but it needs to resolve some of these other somewhat external factors before it can do entirely what it's there to be intended of its original purpose. Can you listen?
Yes. So have they learned lessons? I mean, one of the things we've observed in terms of changes to the decision making is to now have a requirement that a business should be generating some revenue before it can access support from the bank. I think that would probably be a fundamental change which would maybe mitigate the circumstances around Secularity Scotland where, as a business, it hadn't started generating revenue. There were all these regulatory uncertainties. It wasn't effectively operating. I think that gives us some added comfort that, some lessons have been learned. Is it linked to Secularity Scotland or others? But at least we are sure that going forward, the kind of mishaps that might have happened there are unlikely to happen.
Yeah, perhaps again, just getting this really important point, actually, just to signpost the committee to paragraph 65, or just to the other, as well as having a revenue-generating business, demonstrable or proven track record amongst the leadership team, and then the relative ratio of private sector relative to public sector investments. These feel like evidence of lessons being learned, Mr. Simpson, to guard against, and I think it is only that, unfortunately, to guard against potential future events where losses might transpire, but in the knowledge that there inevitably will be some future date.
Okay, that's really useful. Now, when you look across the investment portfolio that the bank's made, from what I could see, it's mostly small to medium-sized, Scottish-based companies who need a helping hand to get to the next stage of their development. So that's all great. But if we go back to the case that the convener was asking about the Gresham House forestry funding, that's not in that category. That's an investment fund who certainly did not need Scottish government money. So is that an appropriate investment for this bank to make?
I think that's a fundamental question for the bank to address. As I say, we didn't look at all individual investments that the bank has made, notwithstanding what we've discussed already with the convener. But actually, is it consistent with its investment strategy and missions to deliver its organisational purpose, rather than going through the individual detail of all the investments that it's made so far? So I think if looking through that kind of forensic detail, that it may be that the bank themselves are better placed to satisfy you on that point.
Well, maybe we'll get a chance to ask them. You mentioned in the report, and I think it's come up already in the questioning, this business of staff getting bonuses, which is not normal in the public sector, as you recognise. Do you think that is, is it appropriate, given the nature of this business? Let's call it a business; it's a bank. Is it appropriate, given the nature of the business, that bonuses should be paid when they're not paid generally elsewhere in the public sector?
So it's not unique to the bank, first of all, I would say, in terms of a public sector context. You know, we do see them in other organisations, and indeed, you know, some that the committee themselves have recently taken interest in. Water industry, for example, as some public utilities also pay bonuses. But it's a very common feature, as we've discussed already, of financial institutions and a public body that is engaging in financial institution-like behaviour. They found, so perhaps it's, I guess the boundaries of my interests and responsibilities, it's not for me to say what if it is or isn't appropriate, but is it consistent with its framework document? Is it consistent with its implementation plan as an organisation? And yes, they are consistent with it. What our interest is, are these being monitored properly? Are they just being discharged? Does it have the right level of scrutiny and governance around it? And that's what we've seen, and that's what's being reported through the annual audit of the bank, Mr Simpson. So they have a dedicated remuneration and nominations committee overseen, as you would expect, by non-executive directors who'll take a view on whether bonuses that to be paid are consistent with the performance obligations of executives or investment-facing staff. And that's the decision that the bank has taken. What we say in today's report is that the bank will want to continue to satisfy itself that it's got these arrangements right, that they are appropriate for this organisation, that they're based on its success in delivering its objectives, and through the Remuneration Nomination Committee and indeed the board more generally, that's something that remains part of its key focus, as opposed to that it just becomes a norm or a routine set of arrangements.
I'm just thinking out loud here. Again, you've said already that it's too early to say whether, you know, a lot of these investments will pay off. So if it's too early to say, why are we paying bonuses when we actually don't know whether various investments have paid off?
Because payoff of the investment won't be the criteria that they're judging investment and executives at the moment. So the detail of that actually is set out in the bank's annual report and accounts, or the criteria with which the long-term incentives plan executives are measured against. And then there's also another scheme for investment staff. So mapping, what effectively you're mapping across to, are they delivering the bank's missions? Are they committing the investment funding that they've received already? And more detail to go alongside that. Whether they get the rate of return and they're paying off, I would anticipate, but this would be a judgment for the bank and its remuneration committee in due course, whether it wishes to evolve the measurement criteria that lead to bonus payments for that point of their evolution. Okay.
Last question from me. You mentioned in the report about the gender pay gap, you know, the gap between what men and women are paid. It's an issue in the financial services industry, and it's an issue in this bank. Is it a problem, and what is the bank doing to address it?
So it's an issue they've disclosed, and you think in terms of it's reported that it's got a median gender pay gap of 30.9% in 23-24. And as we say in the report, the bank recognises that's not what it needs to be, nor would it want to be. I'm quite sure in terms of, as a public body, you know, delivering its equality outcomes. We've seen that the bank is taking some action to address this in terms of the gender balance it has on its committees, established a gender equality networking group, and then also working with employers' network for equality and inclusion. As I mentioned, the Remuneration Nomination Committee already, Mr Simpson, that's also being reviewed by the organisation. It's important that these steps make a difference, you know, because it's got to be both things, hasn't it? It's got to be both a a public body, and having delivering and clearly evidencing its equality and satisfying its obligations, but also operate in a financial services environment at the same time. But so again, it's an important point that the bank takes forward, and to satisfy itself that these steps that have got planned are working, and if they're not, amend and evolve its strategy.
Okay, thank you, Convener. Okay,
thank you. Just one final question from me, and that is the leadership of the Scottish National Investment Bank. I think Mr Denham has recently announced he plans to step down. Ms McTaggart was the former CEO. So we're going to be in year 5 of the bank and seeing our 3rd permanent chief executive. I think there's an interim chief executive. The finance officer stepped up for a period of time. So that's quite a lot of turnover, isn't it, in the leadership of this quite new institution. Do you have any commentary on that?
So factually, you're absolutely right, Convener, and Mr Denham has announced publicly that his intention to retire. The bank, as I understand, are making arrangements to recruit for a new chief executive, and it's stated that Mr Denham will remain with the bank in an advisory capacity into 2026 to support transition handover arrangements. And if that's consistent with smooth handover and transfer of knowledge, that feels like an appropriate thing to do if they've got the financial resources that allow for those arrangements. The other factors in terms of turnover and change, to some degree, it's perhaps inevitable that there is change of leadership in a new organisation, one that's establishing itself. More generally, we've seen in other parts of the public sector, we've commented, I think, with the committee on the NHS, that change and turnover and recruiting and retaining people in senior leadership roles is challenging for public bodies. But beyond that, Convener, I have no further insight into the specifics of turnover, and can only, as I'm sure the committee and yourself have seen, what the bank's public statements have been about why there has been change of leadership at the bank.
Okay, thank you. I'm quite sure that's something we will continue to keep a close eye on. But can I thank you very much for your evidence this morning? It's been very helpful for us. So can I thank Kirsty Ridd, Catherine Young, Cornelius Chikwama, and Auditor General, can I thank you very much for leading on the evidence this morning. I'm now going to move this morning's meeting into private session.